Over in the United Kingdom, latest data released by the Office for National Statistics, the ONS, showed that UK's unemployment rate came in at 3.7% in January. Expectations were for 3.8%, while the claimant count change showed a smaller than expected decline in the reported month. Number of job vacancies in the UK also fell for the 8th month in a row between December and February. 1.1 million was the official figure. The figures come a day ahead of Wednesday's budget, where Chancellor Jeremy Hunt is expected to set out plans to encourage people to get back into work. For more on these headlines, we cross over to London. We're joined by our Rise business analyst, Bode Oshosimi. Good morning, Bode. Thanks for joining us. What did you make of the UK jobs data out this morning?
Well, good morning, and thanks for having me. Analysts are saying that, yes, indeed, there was a fall in new jobs, but it's not cause to panic, as there are over 300,000 more vacancies than there were this time pre-pandemic. That is when you compare with what it was like 3 years ago. That means there's still a healthy labor market. Pay growth appears to be stalling. Good news, down from 6.7% to 6.5%. That has a positive impact on inflation pressures. Unemployment coming in at 3.7% in January versus the 3.8% expected suggests the job market is resilient and can withstand hawkish rate hikes. Wage growth pressures, I think, is always a big thing to look at. But the next big issue could be how to enhance labor participation in the UK, especially when we now begin to see wage pressures are going down. And Jeremy Hunt is expected to address this skills shortage in a budget statement tomorrow that will be framed as a growth plan for Britain's economy. Still the one in the group of seven yet to recover its coronavirus pandemic size. That's the size of the economy. But past attempts to train more workers apparently it looks like the problem has got worse, especially after the pandemic, and some new ideas are needed. The pound did not react much to the data, as all eyes are still focused on the aftermath of the SVB crisis and what the Bank of England may want to do. Pound slightly down 0.3% against the dollar. But the fear of contagion, especially after the HSBC takeover, really didn't do much to address the ebbing sentiment in the banking sector. I think that's where markets are really going to be still focused on, and less so on data, except of course for the US CPI.
And speaking of the US CPI, what are markets expecting?
Well, the recent mayhem we saw in the banking sector following two bank failures, like I said, is creating a lot of recalibration of expectations. And today's release may well imply more monetary migraine for the Fed. The CPI, that's the key indicator of goods and services, is very likely to reveal that inflation growth has moderated from 6.4% year on year, but not enough or not as expected. And further evidence that the Fed's effort to tame inflation needs slightly more push is what we are likely to get. But less likely is still the possible outcome that the inflation rates go up, which will be a nightmare scenario for a Fed now under incredible pressure to pause hikes. Today's CPI, like you said, is going to determine a lot of things, and will be seen almost solely from the perspective of how it affects the interest rate trajectory. Just today, Nomura, that's the Japan stock brokerage, came up with a forecast that the Fed will actually cut interest rates, hit the brakes on quantitative tightening as well, in trying to deal with this as SVB collapse. I think that's extreme, but Nomura's analysis cannot be completely thrown away. They had initially forecasted a 50 basis points rate hike for the Fed March meeting, and of course, they are now seeing a 25 basis point cut, which is quite a turn around. Goldman Sachs had said SVB issues were peculiar to the bank and not systemic, but they still forecasted a pause in March and maybe May 25 basis points, June and July 25 basis points. But all these forecasts, I think, are all going to be sensitive to the data we see later today.
All right, Volkswagen full year results. We saw that this week. What do you make of those numbers, and I guess their plans to challenge Tesla on the EV front?
Well, markets are not impressed. What I just what I usually do is first check what markets are saying about this in terms of the reactions. Volkswagen, I see, is down 3.11%, which definitely is not a very impressive, noting that the DAX is slightly up 0.5%. Yes, their deliveries rose 76% in 2022, with further significant models released in 2023. And they are the market leader in Europe. They made a lot of gain in China, 68% spike in their business there. They also completed the landmark electrification of their plant in Chattanooga, Tennessee. The plan to invest euros, 180 billion euros between 2023 and 2027, and push a lot of that money towards electrification and digitalization. Like you said, is trying to go after Tesla, but I think there's a bit of a learning curve there. They are, of course, also looking at Canada and the US, trying to take advantage of incentives there. We understand there's a new 2 billion EV plant in South Carolina, and they're fast-tracking expansion also in Canada. But I think there are issues that they will have to deal with. One, of course, is productivity. It's getting very difficult to pass on the inflation to the consumer. Tesla has actually been bringing down its prices. So a lot of discounting going on, and Volkswagen tend to be pricey, and they just have to work out how they can get the pricing, the productivity as high as it needs to be. But just like I said, shares fell as much as 3.8% in early trading. As we speak, the shares are also still down on the DAX, actually down 3.11%.
All right. All right, business analyst Bode Oshosumi. Bode, thanks for taking us through the headlines. Appreciate your insights.